What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today, we're going to talk about the Tangible Property Regulations. These were put out back in 2013. We're going to talk about how that impacts some of the options you have when it comes to determining whether you want to capitalize and depreciate a cost or whether you should expense it. So in 2013, the IRS released the Tangible Property Regulations, aka TPRs, to settle a long-running debate. When does a repair count as a deduction or an expense? And when does it need to be capitalized and depreciated? Understanding this difference is key for real estate investors and small business owners. If you capitalize an expense rather than deducting it, you're potentially giving the IRS a loan for up to 27 and a half or 39 years if you're dealing with a piece of real estate. However, if you deduct something that should have been capitalized, you might find yourself being hit with penalties. So you want to make sure you understand the difference between the two and work with your tax advisor to make sure you're taking full advantage of all the deductions that you're allowed. So to clarify, a repair is a current deduction. So that's immediate expense right on the P&L. An improvement is a capital cost that's subject to depreciation. So the first thing we need to do is determine what unit of property is affected by this expense. So there's 9 units of property. We have the building structure itself, escalators, elevators, HVAC systems, plumbing systems, electrical systems, fire and alarm systems. So fire and alarm go together. It's one unit of property, fire protection and alarm systems. We have security systems and then gas distribution systems. Once you determine the unit of property, you need to figure out if the expense is a capital improvement or is it a repair. Let's start with capital improvements. So a capital improvement prolongs the life of the property or enhances the value of the property, or it adapts the property for a new or different use. So the IRS has classified these 3 categories as betterments, restorations, and adaptations. The betterments include those expenses that materially improve the productivity, quality, or output of a unit of property. Restorations replace a major component or restore a piece of property to its operational status. And then adaptations are modifications to a unit of property to serve some new or different purpose from that of its original use when it was placed in service. Now, by contrast, repairs are one-time expenses incurred to keep property in working condition. The IRS defines repairs as those costs that do not add significant value to the property or extend its life. The benefit of classifying an expenditure as a repair is it helps maximize current year deductions, and it also minimizes depreciation recapture in the future. Repairs are deducted in full in the current year, and there's no depreciation recapture later. So you get the immediate write-off. When you turn around and sell a property, you don't have depreciation recapture to deal with in the future. So you get the full time value of money by writing it off in year 1. Now, in the TPRs, the Tangible Property Regulations, the IRS gives us 3 safe harbors that allow us to classify something as a repair. So the first is the de minimis safe harbor. So this is the most common. Most CPAs I see are using it. This one is probably, it's the most straightforward as well. So the de minimis safe harbor allows you to immediately deduct up to $2,500 for any given repair. You can expense it immediately. One catch is your books have to reflect the same treatment. So if you are deducting items under $2,500 using this de minimis safe harbor, your books need to match your tax return. So there's no scrubbing of the depreciation schedule when it comes time to file your taxes. Those costs should already be classified as repair expense. There is a catch here. Your property needs to be placed in service. So if you bought a fixer-upper and say you're still in the middle of your rehab, unfortunately you can't use this one. You also cannot use this safe harbor if you're a dealer because your real estate is now considered inventory. So all those costs are going to be capitalized as inventory. They're not going to be deducted on your tax return as a repair expense. So the $2,500 threshold is for most taxpayers if you have audited financials. The IRS refers to it as an applicable financial statement. That threshold actually goes up to $5,000. So the $2,500, $5,000 if you have audited financials. That limit is based on a per invoice or per item on the invoice. So it is possible to have an invoice that's over $2,500, but it's made up of multiple items that you're allowed to deduct. So let's say you have an invoice, a $10,000 invoice, and there are 10 separately stated items, all valued at $1,000. Generally, you'll be able to deduct this in full under the de minimis safe harbor because each item is under the $2,500. Safe harbor 2 is called the small taxpayers safe harbor. This allows you to write off as repair or maintenance any cost that is the lesser of $10,000 or 2% of the adjusted basis of the property that you purchased. So to qualify for this safe harbor, the property itself needs to have an adjusted basis of less than $1 million. So this is generally going to work on your smaller rental properties. An example would be, let's say you buy a property for $500,000. And in most recent tax year, you put in a $7,000 HVAC unit and you have another $2,000 minor repairs. So all in, total repairs are $9,000. Because those expenses are less than 2% of the property basis, 2% of $500,000, $10,000, and under the $10,000 limit, because remember, it's the lesser of 2% of the unadjusted basis or $10,000. In this case, our total of $9,000, less than both, we can deduct that HVAC in full in year one using the safe harbor. You have to attach an election statement to your tax return. Without the election, no deduction. That brings us on to safe harbor number 3. This is probably one that is most underutilized. So this is referred to as the routine maintenance safe harbor. If you reasonably expect to do something more than once in a 10-year period, like replacing carpet or flushing HVAC lines, it's routine. That means it's deductible, no elections necessary, no red tape. You just have to have good records and a reasonable expectation that this will happen more than once every 10 years. So for example, if you're a landlord that replaces carpet every time a tenant turns over, you can deduct that carpet in full under the routine maintenance safe harbor, where normally your carpet is going to be depreciated over 5 years. So again, this one is very underutilized in my opinion. Now, if you don't qualify for any of the 3 safe harbors, you have to apply what's called the BAR test, the betterment, adaptation, or restoration. Remember, we just touched on this earlier. Those are the categories the IRS uses to determine whether you need to capitalize a cost. So are you replacing a broken system? Then you're going to need to capitalize it if you don't meet one of the safe harbors. Are you upgrading to energy efficient windows? That's going to be a betterment. Over $2,500 doesn't meet the other safe harbors, then you're going to have to capitalize it. But let's say you're replacing 25% of a system, one AC unit in a 4-unit building. That might be a repair and deductible. You need to look at the entire system. And if you're under that 30% materiality threshold, you may be able to deduct that as a repair. Generally, look to the safe harbors. If you don't meet one of them, look and see, is it a betterment, adaptation, or restoration, and apply those tests. Probably need to capitalize it. So too many CPAs just play it safe and capitalize everything. You don't want that to happen to you. Make sure you're talking to your advisor and that they're on the same page with you. They know about the safe harbors. That way you're able to maximize your deductions and you're not capitalizing things that don't need to be capitalized. So that about does it today. If you found value in this episode, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.